Good evening. Thank you. My name is Nick Ritsinas. I am the director of the Joint Center for Housing Studies here at Harvard University. And it is a real pleasure, a real treat to welcome you to the 9th Annual John Dunlop Lecture. A number of you have been with us for many of these lectures. We have always found them illuminating, always found them informative. I would note one of our early lecturers, matter of fact, as I recollect, the 2nd annual lecture is here with us this evening, and that's our good friend Barbara Alexander. Barbara, thank you for joining us. This is a lecture that is open to the public and to the members of the Harvard community, and there are many such members here, but I do want to particularly note and single out a couple of groups who made a special effort to be with us this evening. One are the members of our Policy Advisory Board. The Policy Advisory Board are a group of corporate leaders in the residential building industry in the United States and increasingly around the world who provide core support for the Joint Center. They are literally in the midst of their 2-day meeting, and I appreciate all of you taking the time this evening to join us. I also want to say a special thank you to the members of the board of the National Housing Endowment. The National Housing Endowment is the philanthropic arm of the National Association of Home Builders and has been a long time, indeed, founding supporter of this lecture series. I also want to say a thank you on a personal basis to my colleagues from here at the design school, at the business school, from around the university, who have taken the time from your busy, busy schedules and your full calendars to join us this evening. I want to introduce a couple people to get us started, to help us place in context this important lecture before I introduce our speaker this evening. We are literally in the halls of the Graduate School of Design. The Graduate School of Design is an important, indeed, the core partner of the Joint Center for Housing Studies. We are affiliated with the Kennedy School of Government and here at the School of Design. I've had the great pleasure for a decade of also serving on the faculty of the Design School. It is a place that understands clearly the important role of the built environment and understand how that environment changes over time. We had hoped this evening to have our relatively new dean welcome you, Dean Mohsin Mostafavi, but a little after noon today he took a turn for the worse and is not able to join us, though sends his regards. I do want to, in his place, however, and I do want to especially thank him as friend and colleague for stepping in, is Gerald Caden. Gerald is a member of the faculty of the Graduate School of Design, is co-chair of the Urban Planning Department, and over these many years I've been here has been a good friend and colleague. Let me introduce you to Professor Gerald Caden. Gerald?
Thank you very much, Nick. I came to school today, unusually for me, not wearing a tie or a jacket. And then I learned sometime this afternoon of this call to duty, and I'm delighted to do it. Delighted to do it because of the importance of the Joint Center to the Graduate School of Design. It's something a relationship that we value very, very much, and the dean asked me to do this to express that connection on his behalf, and he indeed is sorry not to be here. So welcome to all of you, faculty, students, and guests, to the event. On behalf of our dean, I want to thank, as the dean would, the National Housing Endowment and the Policy Advisory Board and their representatives for supporting this Dunlop lecture, as well as the Joint Center for Housing Studies. Again, we really appreciate that kind of thing. The connection with the center and the design school is very, very close. Many of the staff people at the center are indeed also members of our faculty, like Nick Ritsinas and Bill Apgar and Eric Belsky. Where are you, Eric? There you are. Alex von Hoffman over the years. Where are you? So that we have a very, very close connection, and indeed they provide many of the housing courses that we offer here. And that's equally true, indeed, at the Kennedy School. And I mentioned the Kennedy School and the Joint Center, and then I mentioned the fact that the design school in general is making, under our new dean, a serious effort to reach out to all of the other schools at Harvard and disciplines and fields at Harvard that, of course, have something important to say about housing. we are working to forge closer and expanded connections with many of the other schools. The Kennedy School to begin with, of course, with the Joint Center as a connector, but also the Business School, the Law School, the School of Public Health, the Faculty of Arts and Sciences itself, dealing with all sorts of important issues, housing being one, but sustainability, urban ecology, digital fabrication, the different ways that housing is produced, as well as the role of design in the narrower sort of sense. The Joint Center does represent, as a result, one of those wonderful kinds of collaborations, and it results not only in the fantastic annual report that is produced by the Center year to year to year, but also fascinating and important research and analysis. And I remember a number of years ago talking at a Joint Center faculty meeting about certain kinds of lending practices, predatory lending practices that could indeed result in the sort of expression of that ancient Chinese expression, may you live in interesting times. Well, indeed, I don't know whether we would use the adjective interesting. In fact, in the remaining minute that I have, I want to find out just how interesting it is by asking a question of interest to me of you. I'm going to ask you to raise your hand for one of two positions. One of the positions is that, in general, you support the currently proposed bailout plan as you understand it, or wait, I haven't asked for it yet, and certainly not from our speaker tonight yet. You don't have to raise your hand. You'll be, I assume, expressing a more sophisticated and deep position than just a hand raise. Alternatively, you oppose it. I will call for both votes. I will make sure that if you don't raise your hand, I'll call on you for your own elaborate answer for the group. So, first, how many people, as broadly understood with the bailout, support it? Raise your hand, please. All right, and if you want to look around the room, by the way, there's just about everybody who's doing it. And how many, okay, here's the brave vote, I guess, oppose the bailout? Okay. All right, so we get a sense then of what we have on hand to hear from our speaker this evening. I'm not introducing our speaker. I turn that over back to Nick Ratsinas. But again, welcome on behalf of Dean Mohsen Mostafavi and the Graduate School of Design. Thanks.
Thank you, Gerald, for so ably filling in. As I said, this lecture series began, this is the 9th year of the lecture series in honor of the late John Dunlop. John Dunlop was a very, very special person, a very, very special man. Indeed, someone who was able to build bridges between the public and private sector is exactly the kind of man who would add value to the mess that we are in today. At the beginning of this series, when we looked out for sponsors, for supporters, we only had to knock on one door, and that door was wide open. And that was the door of the National Housing Endowment. They have been a good friend, colleagues, supporters of this lecture series from the beginning. Indeed, they are generally been very supportive of the research of the Joint Center. One of the pleasures of this evening, it gives me an excuse to see and introduce to you the chairman of the National Housing Endowment. Gary Garzinski is a builder in the Washington area. He is involved in many sort of boards, including a number not only of corporate boards, but philanthropic boards. He is the former president of the National Association of Home Builders. He cares about issues that are vital to our communities and vital to our future, and for the last many years has been the chairman of the National Housing Endowment. It's a pleasure to introduce Gary Garzinski.
Thank you, Nick, and welcome to all friends of the John Dunlop Lecture. As Nick stated, this is the 9th annual lecture that is sponsored by the National Housing Endowment, which is the philanthropic arm of the National Association of Home Builders. We also take great pleasure in every June sponsoring Nick's annual report on the state of the nation's housing. This is done in honor of Professor Dunlop, who certainly was a great friend of housing and had a lifelong commitment to our industry and sat on our Board of Trustees. And tonight we have a third member of that Board of Trustees who is going to address us in this lecture series. In the past, Herb Kohler, chairman of the Kohler Companies, has done so. Tim Eller, who is in the audience tonight from Centex Corporation, also a member of our board, has addressed the lecture as well. Now, the endowment is all about training, education, and research. That's where the money goes to. It comes from people within our industry. We're philanthropic in the terms that it is given free of heart with not a whole lot of arm twisting, but it's not going to any particular charities. It is going directly to try to foster the future leadership of the home building and light construction industry in this country. And for that, we are quite proud. Our signature program is called HELP, which is Home Builder Education Leadership Program, where over the past 4 years, going into our 4th year, we have given grants directly to 2- and 4-year institutions to establish degrees in residential construction. And we think that's what we want to be known for. I've been to a lot of these lectures, and I cannot think of one that is more to the point than tonight's lecture involving Lou Ranieri and where we are in the crisis that we're in this country today. Nick, I'm sure, will go into Lou's background, which is extensive. I can only tell you that he has been a friend to our industry. He has sat, since I think its inception in 1988, as the co-chairman of our NAHB Mortgage Roundtable, which meets semi-annually and is an off-the-record conference of the private sector, the public sector. Hell, Lockhart's been there, I guess, for the past 3 or 4 years, right, Lou? And,
yes.
And it's going to happen again in November, which should also be very timely. So when you're hearing from Lou Ranieri, I think the experience and being someone in the fray, because I can go back to at least 2 years at the roundtable where Lou has been emphasizing this coming hailstorm that we're in and working behind the scenes to do something about it. So again, welcome on behalf of the endowment. I know you're in for a treat hearing from Lou Ranieri tonight. And keep those checks coming to the endowment, or else I'll have to stay on sabbatical much longer than I am now as a developer. Okay, thanks.
Thank you, Gary. I first asked, believe it or not, I first asked Lou to be a speaker 2 years ago, because I knew 2 years ago that at this point in time there would be only one person you'd want to hear from. You'd want to hear from the person who had the original idea of how one intersects residential mortgages and capital markets. You'd want to hear from someone who had insight, who has passion, and knows how we veered off the trail. You'd want to hear from one who has remained active in the field, indeed has been a very important shaper of that field as we has evolved over time. Lou has an extensive and fascinating background. He is currently the founder-director of Hyperion Private Equity Funds, is the chair and director of several affiliated companies, and also is chairman of the Federal Franklin Bank Corporation. He's received many awards, too numerous to mention. The one that I sort of single out, I'll bring to your attention. In 2004, Business Week magazine identified Lou as one of the greatest innovators of the past 75 years. One of the greatest innovators of the past 75 years. Quite a recognition, and in this case, particularly appropriate. What you probably didn't know about Lou is that at one point he aspired to be an Italian chef. Indeed, what a meal has been cooked up. What spices have been used, what pasta has been warmed. So tonight, to talk about his experiences, perhaps as an Italian chef, but more appropriately as a soothsayer, as a truth teller, Lou Ranieri. Lou?
I think I intended making a lasagna. I wound up with a bouillabaisse. I did. I did something wrong. Thank you. It's truly an honor to be here, and I'm going to be my normal frank self. I think that's the way I can serve you best. So those of you who want to throw things, aim low. It's true. I gave a number of speeches. I've been sort of talking about what I was concerned was a growing problem in the housing mortgage area since '05 and '06. What I was trying to say, though, was best summed up, I would think, in a comment that I attributed to Warren Buffett, I believe, who made news again today with his investment in GE. But Warren used to talk about the 3 I's of new markets. The 3 I's being, firstly, you get innovation, then you get imitation, and then inevitably you get insanity. And that is actually his quote. And I was sure we were quickly moving into phase 3, starting in late '05. What I was particularly worried about was the problems, I believe, that were developing in the mortgage securities market. When we built this industry, it was based on the notion that house was shelter and a lifestyle decision, not a new form of ATM. Too many structures did not depend upon the belief that the borrower could afford the house till he sold it, or afford the house and pay it off over a long period of time the way our parents did. The structures, so many of the mortgage structures, depended on a subsequent event, and in effect, you had to refi your way out of the home you now owned. A mortgage structure that requires a homeowner to take any subsequent event, pardon the pun, is a house built on sand. Housing values go down. We didn't believe that for a decade, but I think we're having it hammered home now. And interest rates will go up again, especially if we're at 45-year lows in rates. I'm so old and have been in this so long that I actually remember the first form of a California ARM. It was called a graduated payment mortgage. We got to know it affectionately as a GPM because virtually they all defaulted because interest rates skyrocketed and that first version had no caps or floors and it blew up in our face. We went back to the drawing board led by the great Jim Montgomery, who redesigned the ARM and put in caps and floors, and we actually created a viable structure that has gone through over 2 decades now without becoming a GPM because it didn't force the homeowner into a subsequent event, and it did not depend on housing appreciation or interest rates staying low. When we started developing versions of, as an example, the subprime loans in structures generally referred to as 228s or 327s, which is a loan designed at the end of 2 years to force the consumer to do something, i.e. refinance, because if it rolls into the new ARM, he could never have afforded it. He couldn't have afforded it on the first day. He certainly isn't able to afford it on the 3rd year. That's also true with payment option ARMs. You know, Jim Montgomery in his version of the California ARM would have a small teaser period, we used to call it, but it would be 3 months or 6 months. It wasn't the violent payment option design that we put in the market where the person could pay 1.5 or 4 or the fully indexed 6 when it rolled up. Well, very few humans ever paid the 6. They all kept paying 1.5. So at some period, this thing was going to cap out at, let's say, 115% loan to value. If he couldn't get out of the loan before then, the payment shock was more than the old GPMs were, because you were now paying fully indexed at 115% of the original loan balance, and unfortunately, the property values have become upside down. The other problem I was really concerned about was the checks and balances in the capital market, the mortgage securities market, were one by one being decimated. And that was partially as a function of the fact that the private sector was taking volume away from the agencies. I mean, it's sort of strange. And then the agencies decided to reverse it by buying the private sector securities anyway. So, I mean, it wasn't quite exactly how it was supposed to work. But as the private sector took volume from Fannie and Freddie, it basically tried to find more ways to make money because nobody felt they were a fiduciary. Everybody in the chain of title was saying, not me, I'm just an agent, whether it was the realtor, the broker, the mortgage company putting together the security, the dealer underwriting the security. Nobody wanted to be responsible for anything. The last bulk work in the checks and balances were in the public securities, not the Fannies and Freddies, were the support tranche buyers, because they had to take the risk. They were going long the below investment grade tranches. Now, by the way, the SEC in its wisdom said, oh yeah, this is okay, this is a 144A and we don't have to have oversight because these are sophisticated investors. Okay, that was true till, again, that was corrupted, because what happened was we invented the collateralized CDOs, collateralized debt obligations, and the street had finally found a way of eviscerating the last check and balance, because now they could take those support tranches, which once used to be sold to very sophisticated mortgage investors, and stick them in a security, not sold individually to a sophisticated investor, stick them in securities which were then repackaged and sold all over the world, where the ability to reverse engineer what you were buying was virtually impossible, and the disclosure in the documents were non-existent. So we had finally driven a hole in the remaining fence of the checks and balances of the system, and it was kind of easy for people like me to say, this can't go on. We have these securities now being levered by the derivative structures and sold to people who couldn't conceivably know what risks they were buying. My favorite example was when one of the geniuses came up with a structure which took support tranches of home equity loans and second mortgages, and they combined 46 support tranches into one security and got a majority of them as AAA. And I'm going, I don't think this works this way. I mean, you know, you can 46 times nothing can frequently equal nothing. I mean, those are what I was focused on. Those are what I was complaining about for 2 years. What I missed and what I did not focus on, and which is certainly part of this brew that we're currently dealing with, is the whole issue of leverage. The collateralized debt obligation was an early form of the leverage which the derivatives market brought to housing and the housing securitization market. Derivatives, the collateralized debt obligations generally levered the underlying mortgage 10 times, the mortgage security 10 times. Some of them did even more. Then you saw the development, and I could give you many examples, but I'm going to give you one that I think is the most relevant right now, is the CDS, credit default swaps. Credit default swaps have literally doubled in the last, well, 2.5 years to over $50 trillion, and they're completely invisible. There's no oversight. There's no reporting, and everybody got them. There's virtually no bank, no insurance company, no pension fund who isn't in some way touching credit default swaps. And the leverage is extraordinary. And most of them, or a large portion of them, and they keep arguing with me, but I'll be proven right about this, are again tied through the mortgage securities and the collateralized debt obligation market to housing. Then, if I missed the leverage issue, I really didn't understand at the time what the result of true value accounting would be, which was put in force in '07. nor did I really understand what the rating services would do after the house of cards came down. Those items I missed, and collectively they're all part of this brew. Let me elaborate just a bit. Housing is a levered investment for the homeowner. So we start with leverage. The homeowner puts a down payment and he takes out a mortgage. Mortgage securities are held in institutions which lever the mortgage securities. Banks have 10% capital charges, so they're 10 times at least, if not more. And the government agencies, when they own them, lever them more than the banks lever the mortgage securities. REITs own mortgage securities, they lever them. And as I said, then those securities got put in CDOs, which were levered one more time, and then we got the credit default swap market on top of that, and we created this big balloon, this big hot air balloon. If you looked at how many times an individual loan was ultimately levered, it was over 100 times. So you radiated the typical losses we were used to and we grew up with in housing into this infinitely larger problem. Then, of course, we stuck the pin in the balloon. What I never would have envisioned was the pin was going to be the true value accounting and the born-again rating services. They remind me of sort of born-again Christians, railing against an unfair fate. And in the middle of this crisis, obviously, that pin has been devastating. And I sort of liken this to, my friend told me, because I was talking about this, and he said, well, did you know, Lewis, and he was obviously an academic, because none of us in Wall Street would ever know this. He said, Lewis, did you know in 1929, stocks could be bought with 5% down, but houses required a 50% down payment? And he looked at me and he said, isn't it true that over the last period, 2000 to 2006, you could buy a house with 5% down? And I said, sure, maybe even nothing down. He said, well, remember, equities now need a 50% down payment. Very prescient. It's kind of interesting. We should not be so surprised about where we are. Where we are is that the private market is completely closed down. And the confidence that it took us almost 35 years to build in the mortgage security sector is gone. The premise we built that market on was that a mortgage security and its corresponding credit mechanisms, whether it was a cascade of tranches or an MI pool policy or an agency guarantee, had to enable the buyer to be an investment professional, not a mortgage savant. We always said that because we thought housing was too big to build a business based on millions of housing savants who really would understand all the dynamics behind the security. Well, right now we don't really have to worry so much, at least immediately, about mortgage securities because the government owns all of the mediums through which you can issue. It owns FHA, it owns Ginnie Mae, it owns Fannie, it owns Freddie, and the biggest buyer may very well be the Treasury and the Fed. Well, unless we really want to have this interesting form of socialization for housing going forward, we're going to have to take a step back and, in my opinion, really start all over again in a sense. 35 years later, we're almost back to where we started. And in that context, I guess if you're going to start all over again, you might as well start at the beginning. And this is the housing production system we're talking about. So I think we should start by talking about builders. And Gary, I actually used to own a small builder in Florida, by the way. He never chooses to ever remember that. He'd rather have me as one of the Wall Street guys with the scarlet letter on my head, but I was once him. So I think we should talk about the housing production system. If you want shoes, you need shoemakers. If you want suits, you need tailors. We're not going to have much housing if we don't have builders. The builder community is being decimated beyond anything in my work experience. I mean, it's horrific. The industry is certainly to some degree at fault. I'll give you one example, and all of the public builders in the audience remember AIMLO. You know, starting in '03, my perception, some of us in the street perceived that the builders started to get confused about what drove stock prices. And it wasn't margin, they thought it was volume. And unfortunately, other capital market structures like preferred stock and sub-debt, items like that, mezz, crept into the builder community where it really had not existed before, and it was deployed, and the result was that many builders had more spec homes, 2 to 3 year supply of finished lots, and more raw land than any time before. So they carried into this period, you know, much more historically illiquid assets than would have been possible in the past. And the banks, we the capital market, we the banks, certainly got our hands dirty because funding was easy, and we went in many, many cases to borrowing-based loans. You know, borrowing-based loan is very easy for the builder. It's very easy to administrate, but there's a real problem. You're asking the CFO of the company to certify his own financials, and that company may also have its own title company and its own mortgage banker. It's really hard to keep checks and balances in the system when you're doing borrowing-based loans. You're asking somebody in a crisis to be somewhat superhuman and better than most of the rest of us. And from the point of Wall Street and from the point of the banks, the topping on this cake was when the law firms started in this crisis recently soliciting builders to file bankruptcy. I can give you many, many instances where builders, which historically the banks would have done a restructuring, and where builders actually had substantial cash, and the law firm said, why do you want to do that? You'll come out of this thing much better off if you file bankruptcy. You can cram down the debt. You can cram down the preferred. You're not going to hurt your bank friend. He's got the loan. And by the way, they need you. Why go do it the hard way? Let's go do it the easy way. And we were finding companies we had lent to filing bankruptcy say, why did you do that? We would have worked with you. And they would tell us because it was better. They came out of it better off in a bankruptcy than they did the old-fashioned way of doing some kind of a restructuring. The problem with that is it's created this impression of the industry that is going to take a very, very long time to heal. Most importantly, in the regulatory agencies. When I said I owned a small builder in Florida, and the first thing I learned was that land eats at your table 3 times a day. That's very true, especially now that we're dealing in the never land of appraisal problems. And I'd really like to go into some examples of this because I don't know whether you've covered this in the meeting today, but it's one of the reasons that the banks are losing so much money and we're shutting down so many home builders. You know, raw land was always appraised on an as-is basis, but development projects were always appraised on a conservative as-built basis. Now we have situations where examiners looking at a development deal, now this is a deal in progress, where lots are still being sold, maybe slower than before, but they're being sold, and the examiner insists on an as-is basis. He gives no value to the built-out project. You get hysterically low appraisal numbers on that basis. I was told of and by the way, it's a sort of no-win situation. There's another project I was told of where the appraiser used such a long sellout period on this is a project that was about to go into production that the builder said, please do it as is, I get a higher price than I am on a build out because you're saying 20 years. So, you know, heads I win, tails I lose. Then a common issue now is using very high interest rates to PV the cost. I see appraisals using 16%. This is in institutions where the real cost of money is 4 or 5%. Well, the difference between 4 or 5 and 16 is like 60%, 50, 60% in the value of the project. So, you know, the typical bank, when he's being examined, you know, is dealing in this sort of three-dimensional chess game of what is the project really worth. The results are tremendous losses for banks and bankruptcy for builders. The latest builder survey, which Gary and the NAHB was kind enough to share with me for this purpose, in the survey, 89% of the respondents reported problems in financing new projects. Well, surprise, surprise. If the minute you make a builder loan, you know you're going to have a dialogue with an examiner, or your stock multiple is going to get cut in half. You can be a bad residential lender and find capital if you need it. If you got a big builder portfolio, you are toast as a public company. That's a very powerful distinction. I could be the dumbest residential lender. I can do 125s, and everybody thinks they can put a box around how deep the problem is, and I can get capital. If you're a big builder, lender, you should see what they do to your multiple, because they don't think they can find the bottom of that loan portfolio. 27% of the respondents reported problems potentially repaying the loan, and in the West that number was 45. There are real problems, but we're making them much bigger than we really need to. And we really need to sort of in some way get everybody in a room and lay out the rules for how we do appraisals, for how we value these projects, or it's going to be really hard as we come out of this. Even with the small community banks, because eventually they get examined too. We need to come up with a set of rules that are the rules across the board. One of the other problems is many, and I don't know whether this comes out of Washington or whether it's regions or whether it's individual examiners, but it's irrelevant when you're the victim. They've come up with this notion that that for a loan to be ranked, you know, rankings are 1 through 7. For a loan to stay above 5, you need 2 forms of repayment. Well, in a development loan, the real form of repayment is building out the project. Of course, personal guarantees and the builder's the builder's money counts, but the real form is a development. The normal way you deal with oversupply and loans in this environment is you mothball. You and the bank get together and you say, look, the best thing is to, rather than what the original development was going to be, we're going to mothball section 3 and 4. We're not going to waste money and capital and effort. We got to put this thing away for the time being. If you do that, you have now gone to one form of repayment, the builder, and they want to underwrite the builder's ability to carry the project on his own. It ain't going to work. You wind up taking a current 3 and making it a 6 or a 7. As I said, I don't know whether this notion of 2 forms is something mandated from somebody at the top, but it is a real and current problem. So we need to get this in some way out in the open, discussed, and set up rules, and everybody knows what the rules are, so that individual builders, individual institutions are not victims of somebody doing it one way when the other guy is doing it a different way. On to the main event. The main event, if you don't happen to be a builder or a bank with a builder portfolio, is the finance system. The biggest and most necessary challenge will be rebuilding Fannie and Freddie. We're not going to have a market unless we have a deep, stable institution willing to, institutions willing to take appropriate risk and carry it into the future. Properly reconfiguring, I'm from Brooklyn, I'm sorry. But then you didn't think I was from Boston anyway. Reconfiguring Fannie and Freddie is the most important thing we can do. Well, how do we do that? Well, you get an argument. It seems the world seems to be devolving into two separate camps. There's probably more than two, but two principal. Some want the GSEs to stay wholly government-owned, and others want them to be privatized. I don't think either of these extremes works well. During the takeover of Fannie and Freddie, Secretary Paulson made it clear that his view that the quasi-government nature of these two giants had to change. Well, I think he's right, but I think the trick is in creating a more responsible structure that will make them relative and effective while also providing the explicit guarantee. Think about it. What value would the totally privatized Fannie and Freddie bring to this uncertain market and carry it forward, as far as I'm concerned, for the next decade if they could no longer provide government guarantees? It's hard to see them being effective under any of those circumstances. The guarantee function always set them apart. It's been their true value, whether it was implicit or now explicit. And they would lose that value as private entities without that guarantee. So if privatization, total privatization wouldn't work, what about total government ownership? The answer to me is that's not really acceptable. Do we really want the government on the hook for all of the risk? I don't think so. And by the way, I don't want all the regulation that would unbelievably come with a totally governmentalized housing finance system over time. Beyond the implications for the taxpayer, the total government takeover would mean losing the superior risk, I know you're going to laugh about this, superior risk analytics and innovation that the private sector can provide. Yeah, you know, I know that sounds funny. They just foreclosed on the two entities. But if you look at the technology that sits in Fannie and Freddie versus FHA, you would understand what I'm talking about. I mean, the private public sector could spend the money. You know, did it spend it all wisely? No. Did it do some other things? Yes. But it is really different than what happens in a purely government entity. So, and most importantly, you need to have skin in the game. I think the most important part of what comes out of this is real skin in the game, not playing with somebody else's money. So I believe the private sector role must be safeguarded within the whatever agency sector comes out the other side. Over these past many months, we've seen what happens when borrowers and lenders don't have real skin in the game. I'll make you laugh again. Look at the MI industry. You say, what are you talking about? They're all going broke. But if you look at the MI industry, and you don't have a bias because they haven't honored your claims lately, they do have skin in the game. They put capital behind loans, they insure, and when loans go bad, they pay the losses, at least most of the time. That's unfortunately what they're doing now. That's what they're intended to do. And they provide a shock absorber, therefore, to the system. Rising losses have prompted them to reassess their policies. They've tightened guidelines, tightened underwriting, and they're putting more emphasis on risk. And that's what they're supposed to do. But at least the money they're spending is theirs. At least the losses they're taking is their shareholders and not the government's. And I'm not holding them up as this great model, except I'm saying look at the difference. When you got real skin in the game versus playing around with somebody else's money. Now, if we don't want pure government, we don't want pure private, what's the alternative? Well, let me give you two forms that just put something on the table to think about. The first one is a sort of co-op like the Federal Home Loan Banks who once owned Freddie Mac. I actually remember they owned Freddie Mac. The Federal Home Loan Bank system owned Freddie till we made them spin it out. In a sort of co-op structure like that, each lender would have to buy into Fannie and Freddie, and the federal government would guarantee the MBSs for a fee. Some kind of co-op, I think, is a viable idea. It worked for the home loan bank system, and I don't see why it can't work, that the users have to buy in, that's the skin in the game, to the entity issuing the guarantee on behalf of the government. The other would be a utility-like structure, and I know this is talked about a great deal now, with cap returns maybe around 10%, just like a public utility, just like an electric company, and it would have a board, and maybe you would have consumer advocates on the board. Both of those kinds of structures have proven viable over very long periods of time. As I said, the other question now is, do these agencies, the reconfigured Fannie and Freddie, need a portfolio? If you remember when Freddie Mac didn't have a portfolio, I do, it was very profitable. It was a big insurance company. Fannie and Freddie will take a long time to unwind their portfolios. In fact, they're going to be growing them $100 billion before they even start to shrink them in 2010. We, our industry, and some of you who are involved, remember when we used to know how to distribute mortgage-backed securities. We used to know how to create CMOs and take 30-year loans and cut them into tranches. And we can remember how to do this again. We don't need CDOs. And we have the benefit now, over the period at which the government is shrinking the retained portfolios of the agencies, of having real government paper to sell, not make-believe government paper or almost government paper. So I truly believe in that sort of 10-year wind-down period that we can actually rotate. We can build a market that can take the sheer size of housing without having Fannie and Freddie having a portfolio in order to be effective. Now, they can always have a portfolio to intervene during crisis periods, like they did during Merriweather. I'm not against Fannie and Freddie. I think all of you know that. When the Merriweather crisis hit, the only market that continued to function, the Treasury market shut down in that brief 48 hours, was the housing market, because Fannie and Freddie stepped in and made the market work. So using a portfolio in that regard is fine. Using a portfolio to generate income for shareholders so that the shareholders and management get it when times are good and the taxpayers get it when times are bad is not a model. It doesn't work. The other thing is, I think we need to think about how to get portfolio lenders, whether they be banks or whomever, in the business again. They have been tremendously squeezed out of the business over the last decade because the margins have been too narrow. It's very hard for the typical bank, the typical thrift, the typical credit union to make enough net interest margin because of the competition both from the agencies and the private sector creating mortgage securities. I think we need to figure out how to use some of their money on a full-time basis going forward, just also because they tend to be more stable through these periods. And I think we can come up with ways to advantage these portfolio lenders. You've heard a lot of conversation about covered bonds. Well, covered bonds are an interesting idea, and as a liability tool for the head of Bank of America, it's interesting because a covered bond gives him one more quiver to get money. But covered bonds are generally 3-year obligations, rarely 5, and they're on balance sheet. So you get no off-balance sheet treatment, and so what you have is the loans plus the company. So not surprisingly, even with the born-again rating services, you get a AAA rating. But you could just as easily issue debt, except that you wouldn't be AAA in most bank cases. And I'm not poo-pooing it, it's really viable. But if we can develop covered bond structures that look like the underlying term of housing, 30 years as an example, so we're not simply trying to match a 30-year loan with a 3-year liability, it would become a very viable tool. And then I would argue that there's a business for the redesigned Fannie and Freddies. make them use the government credit. Because in the covered bond structure, you first have the loan, then you have the entire balance sheet of the bank. So making it into a government rating is a very small risk. And so instead of getting corporate AAA rate yields, you get government AAA yield. And so you'd really be giving a bank or a thrift issuing covered bonds the kind of income advantage, because they're using up their balance sheet, and they would get enough margin to both use up their balance sheet as well as pay the government a fee. The other thing I think we should do immediately, which would help the portfolio lenders, is change the capital requirements, the risk-based capital requirements on the agency paper. It currently stands at 20 basis points. Ginnie Mae's is 0, Fannie and Freddie are 20. Well, you know, and mortgages in general have been 50 up till now, until they take reserves on top of it. But why are we still charging 20? The government is the government. There's only one government I know of. There's a tremendous amount of paper in the system, agency paper. If you cut that 20% to 0, which is where Ginnie Mae already was, you'd free up a ton of capital in the banking system. And I don't see why not, unless you're moaning about Ginnie Mae being 0. And right now, I would err in the direction of believing the government is money good and free up the capital. Here's where I get to have my say about true value accounting, and I know all of the purists in the room will really start throwing things, so please, again, aim low. I'm not trying to cook the books or cloud the reality of balance sheets. But why, with any logic, would anybody buy my 30-year mortgage securities if they're in the held to maturity or the held for investment portfolio? If at some point over that period, somebody can come in and say, OTTI, you know, other than temporary impairment, you know, based on some view driven by some market crisis about a permanent impairment. And then on top of it say, well, wait a minute, it's really OTTI or market, which is ever lower, which is you mark it down to the other than temporary impaired level, which is theoretically a cash flow model, or the market price. Well, I know the SEC came out with a series of clarifications today to try and head off any conversation about true value accounting. But the problem with true value accounting is, why would anybody want to hold a 30-year instrument if the risk is that sometime over the life of that instrument, he's going to take a capital impairment? And the worst part of the capital impairment is if the accountants and the market was wrong, you take the loss up front, poof, out of my capital account. If it turns out I was right, I get to take it back over the life of the loan. On a present value basis, I never get even. You know, true value accounting all by itself can make a 30-year loan obsolete. You got to be crazy to take this risk-reward scenario unless you so clearly define what you mean by a permanent impairment in a way that a rational risk taker will take the risk. And that's not where we are now. That's not what's happening to institutions today. There's got to be some way of doing this which neither clouds the reality of balance sheets nor makes long-term assets obsolete. Sorry, you can see I'm a little bit messianic on this, this particular topic. Anyway, let me go on. Solid underwriting is, after all, the basis of the market. And we sort of forgot it, and I'm going to go through this quickly to get to what's going on in the last couple of days. But remember, structure alone was never a solution. It's been a mistake to believe yield and housing price appreciation could have substituted for solid underwriting. I've already told you I think we need to go back to structures that do not force the homeowner into a subsequent event. I can name 3. The 30-year loan, which is still, I think, and should be the bread and butter of our industry. the California arm, the one that's been around for 2 decades, interest rate up and down, housing value up and down, because it doesn't force a refinancing. And I would even go along with something like a 7-year balloon, but with amortization. And you say, all of the real estate guys in the room say, dummy, there is no real amortization in the first 5 years. And my answer is, I know, but when you underwrite a 7-year balloon with a 30-year amortization schedule, it creates a higher level of income that's required than just doing a 30 years, just doing a 7-year zero. And that difference is frequently the ability to carry the loan in a difficult environment. And that's why a 3-year IO or a 5-year IO is, again, a dangerous instrument. But if you just look at the underwriting, just look at the result of the underwriting, it's a simple, dopey change. Make it 7 years so housing and inflation tend to work for you as they normally do in housing, and do it and use a 30-year AM schedule, and you'll see what I mean. It sounds like a little, it makes a lot of difference. Now I'll get on another of my high horses. And this one I love almost as much as I love true value accounting. It's home equity, piggyback, and second mortgages. We are currently, piggybacks and home equity as an alternative source of down payment were a problem. Seconds and piggybacks and home equity have become an immense problem, because in this, we didn't underwrite on combined loan to value. And we didn't, so it obscured the reality of the homeowner's ability to carry this loan. And what's worse, now when we're trying to restructure the loan, we keep stumbling over the second mortgage. We have had a very difficult, in fact, an impossible time getting everybody to agree what you do, the second mortgage holder, and all 3 categories, I'll just call them seconds, whether it be piggyback, home equity, or seconds. We can't get a general understanding. If the house is upside down and the first mortgage lender is actually willing to restructure and take a principal loss of in excess of 10%, the second is worthless. Get out of the way. Don't force the lender to go to foreclosure. And there is no way around it. We have tried over and over and over again. Treasury held a conference and put everybody in a room and couldn't get an agreement. In California, many institutions have tried to find ways, and you can't. The law prohibits. If the first mortgage lender can be accused of tampering with the second leapfrogs the first. So we find ourselves putting homeowners into foreclosure where the first mortgage lender has already agreed to do a restructuring because the second won't give an inch. He won't return a phone call. And by the way, if an 80% loan to value is what we need in underwriting terms, what difference does it make if somebody can come in right behind you and lever it up? Or a homeowner uses his house as an ATM. Every time he gets $10 worth of housing price appreciation, he refinances it out by putting a second. And then the first time values go down, we have DTIs that don't work. How do we ever make an 80% loan to value loan that stays 80%? We need to deal with this issue. Right now, we need to deal with figuring out how to make them go away so we are not putting people in foreclosure who don't have to go to foreclosure because the first is willing to deal and take a loss. Part of the answer is capital rules. Part of the answer, and I wrote the original reg. You're looking at the guy who wrote the bankruptcy exemption for first mortgages. I finally gave up. I've been so frustrated over the last 8 months. I actually told Martin Eakes I would support his cram down. You don't know what that is for me to say, I will support your cram down. That's like disemboweling myself. I'm doing the mortgage version of Harry Carey, but that's how frustrated and how upset it is that we're throwing people out of homes. And by the way, the hierarchy A vested self-interest is a restructuring around a credible borrower is always a better deal than a foreclosure, and it's even better than a short sale. So it's vested self-interest for the first mortgage lender to do a restructuring. But it's evil to foreclose on that guy because a second which is worthless is in the way. As far as underwriting is concerned, let me remind you of something that those of us who have been around a long time used to talk about in underwriting. We call it a mantra. We used to say the 4 C's of a good loan. The 4 C's of a good loan were commitment, credit, collateral, and capital. Commitment, the home as a lifestyle decision by the homeowner, not an ATM. And we used to look at that. What was going on? Was this a cash out refi the 3rd time? Bad loan, no commitment. Credit, the ability to pay, not the ability to refi your way out, maybe. Front end, back end DTIs, combined loan to value. Collateral, full appraisals from a qualified underwriter. And a down payment that made sense. I'm not against doing 95s. I'm not against doing 90s. They just have to be done with full knowledge and somebody putting risk into the game. I don't care if it's an MI company. I don't care if it's HFA, and they put blinders on and say, I'm going to do low to mods. I know I'm taking risks. I'm going to do special underwriting, and I'm going to make special rules to do this. Or if the government wants to basically say, I want 68% housing ownership, and I'm willing to take losses to do it, it's okay by me. I've been in housing all my life, but I want to do it with my eyes open. And I don't want to extend that privilege to every monkey who wants to create a one-way option out of a house. If the values go up, I get it immediately because I refi it out with a second. If it goes down, I just hand you the house back and say, you lose. Let's talk about current events, because I'm sure you're tired about hearing me talk about the mortgage market. It's more fun to talk about current events. I truly believe, I was at one point in charge of all trading at Salomon Brothers when Salomon was the great trading firm. So I used to figure out all the new and amazing ways to lose money in markets all over the world, but including equities. But I can tell you that the SEC needs to reimpose the uptick rule. Taking out the uptick rule in 2007 was, in retrospect, a major policy error. Most of what has been going on could have been prevented if the uptick rule were in place and imposed. We can design a modern version of the uptick rule, but all of the little tinkering they will do will not fix it. We need to reimpose the uptick rule. And by the way, the SEC needs to impose the other rules that already exist about acting in concert, about spreading rumors, about playing around. I mean, the rules exist. We just need to vigorously impose them, but we need the uptick rule. I've mentioned a couple of times credit default swaps. Whatever the process is, the regulatory system, somebody who will take it serious and has the ability to issue a report needs to look at the CDS market, and somehow or another it needs to be, whether you put it on an exchange or in some way regulated, because we need disclosure, we need transparency, or we're going to keep wiping out big institutions. When the SEC basically imposed rules to keep hedge funds and others from shorting financial institutions, including GE, all the action went from shorting the stock to playing around with the credit default swaps. This morning at 8:30, GE was trading at 830 over, 830 basis points. So you can push, and the stock of GE was affected. These markets are really linked, and credit defaults is immense. I think it's actually 56 billion. You can't have a 56 billion invisible man in the room. He is easily the 800-pound gorilla. if you really want to make the market function, you got to bring him somehow into the system. What the program, I think the Senate rather, is hopefully voting on now and will pass. One of the things they're doing is raising the FDIC limit from 100 to 250. I would tell you, since they guaranteed 100% of mutual funds, why are we raising the FDIC limit only to 250? The object is to keep the funds in the banking system, not find reasons to move them out. What would have been the difference to just guarantee on a temporary basis, make the FDIC guarantee unlimited in the same way they made mutual fund guarantee unlimited? They didn't say how much money you could put in a mutual fund. They just guaranteed it. Remember that for small businesses, it's even hard to stay under the 250. Think about payroll. If you want to close your house, you're going to have at one point in the bank somewhere more generally than 250. So what are we going to do with those guys, which are the core of the real banking system? Why the 250? Why not the same thing we did for mutual funds, even on a temporary basis to stabilize the system? Now, I raised my hand prematurely when they said, who's in favor of the bill? I was the first one up. And the reason is because the real crisis is now going on in the money markets around the world, not in housing. Housing is a real crisis, but the most immediate crisis is to stabilize the short end, because if you don't stabilize the short end, we won't have to worry about the long end. And the Fed is putting in everything it can. It cannot put in an unlimited amount. And the core of paranoia is coming from housing. So what Secretary Paulson and Fed Governor Bernanke said is true. We don't fix this forever until we fix housing. I would remind you they already have a $300 billion bill passed and in law that we're waiting for the enabling legislation on how to use. Hopefully, if they really, and this bill, unlike any other bill I've ever known, is flexible in its implementation. The authority was delegated to, I believe it was the Fed, the FDIC, and Treasury, and did I leave somebody out? I think it was the three of them, to actually write the rules and keep moving them around till they got it right. But that's $300 billion that was targeted to keep people in homes, to give you a place to go finance a problem loan. That's a lot of money. The 700 would be on top of the 300, and if used right, 300 and 700, and even if you say you give it to them in 2 or 3 pieces, it's going to get to 700, will make a real dent if it's used well. What does used well mean to me? Buying toxic waste in banks is not used well. I could care less if they go buy, super subordinated pieces that nobody could figure out what the real value was anyway. I mean, think about it. How do you figure out the real value? You'd have to be able to make a decision about where you think California housing values stabilize and when. There is, in my view, is one of the things they can do is spend the money to take the good stuff out of the system. The mortgage securities market is closed except for agencies. You can't reproduce what's sitting in the system. There's no more. There's not going to be more anytime soon. I'm already over, huh? Okay, I'm sorry. So I won't talk about how they should use the money. Okay. Think about it. There's a ton of money sitting on the sides in pension funds, in mandates. If you start to pull out the best paper, which they know full well you can't reproduce, you can push them in the market, because the best paper is as mispriced as the worst paper. And there's a lot more dollars of best paper than there is tiny pieces of worst paper, which you can't figure out anyway. The object is to make the system work for you. If you start gobbling up what they can't get back, and the pension funds and the money managers and the institutions see AAAs suddenly, which frankly are worth par, which are now worth in the high 70s, moving up, you'll pull them in. And they got almost as much money as this bill. that will make an effect much quicker than buying tiny pieces of toxic waste. Also, builder loans. You know, the reason I know builder loans are too cheap, the vulture funds are actually starting to look at the builder market. And they're interested in investing in home builders and buying at dopey prices, but buying builder loans out of banks. It must be cheap. But if the TARP, which wasn't a great name, you know, a TARP, as a builder knows, is something you throw over a lot of stuff that is unsightly. You know, if the TARP were to, in fact, start buying, again, the good builder loans, you would really make a difference to a bank, because it's a big capital charge, right? And you start to liquefy what is their worst position in the context of their stock multiple. You could also think about the TARP buying second mortgages. If you bought second mortgages at 15 cents on the dollar, you could turn around and forgive 75 cents on the dollar of indebtedness. That means they'd make 10 cents. And nothing lowers DTI faster than forgiving principal. You can change rate all you want. Forgive principal and you change DTI front end, back end right away. You make affordability change right away. So if you started forgiving 75 cents of second mortgage dollars, you would make a difference. If they got the firsts, then for sure they should buy the seconds, because then they're not going to stumble over the same issue as everybody else does. I would also tell you that using some of their money to finance, we have many areas where we have more houses than we have people to go into them as homeowners. We got to get them out of the way. I wouldn't mind the TARP becoming a partner with speculators, whoever you want to call them, who buy these houses and convert them to rental, because that's going to be the best use of some of those properties, other than turning them into parks for the near term. They would make a real difference. And we could bring back rent to buy. I also think $7,500 is not enough tax incentive in places like California and Florida. We got to, if we don't get it changed from 75 to 15, they ought to subsidize it in those areas so that that first-time home buyer tax credit is enough based on housing prices and income areas to make a difference. And the favorite, one of my very quick favorites is the reauthorizing the HFA tax-exempt bonds for distressed homeowner rate. These guys are everywhere you need them. They know the business. Give them the money, give them the mandate, they'll go do it. You just got to give them the authorization to go out and do it. And oh, by the way, don't forget moral hazard, which means don't do a giveaway to a guy who's refinanced his house 3 times, bought a Rolex, a Mercedes, and a second home, because otherwise we'll never have a housing securities market, because you will have confirmed in everybody's head that a house is a one-way option. Housing values go down, the institution lose. Housing values go up, I get the money. Thank you.
Thank you. Thank you very, very much for both that practical and insightful and wise counsel. I feel like we should fly you to Washington right now as we speak. Lou is gracious enough to join us at a reception that is open to each and every one of you. He'll be here for the next 45 minutes or so, so please come down and join us. The reception is diagonally across the corridor here in the Stubbins room. Thank you for joining us at the lecture this evening.
Great.